40%. That is the exact slice of your family home HMRC will demand even if you have already signed the deeds over to your children. For many, the family home is more than just bricks and mortar. It is the ultimate symbol of a lifetime's hard work. But in 2026, thousands of parents are falling into a devastating financial trap. In an attempt to avoid inheritance tax, they secretly gift the house but continue living there rent-free. HMRC calls this a gift with reservation. Under this gift with reservation trap, the 7-year clock never even starts ticking, leaving your children with a massive tax bill that often forces an immediate sale of the property just as they are grieving. Today, I'm exposing the hidden rules of the 7-year trap, why your generous gift might be viewed as a tax evasion attempt, and the specific legal steps you must take to ensure your home remains a sanctuary for your family, not a windfall for the Treasury. To protect your estate from these aggressive enforcement shifts, please subscribe and turn on the notification bell. We begin with the invisible landlord rule that every homeowner needs to hear. Section 1. The 40% threat. Understanding the 2026 thresholds. To understand why so many families are currently at risk, we must first look at the cold, hard numbers that define inheritance tax in 2026. For many years, inheritance tax was seen as a levy only for the incredibly wealthy. However, because the government has frozen the tax-free thresholds while house prices have continued to rise, it has become a stealth tax on the British middle class. The primary figure you need to remember is £325,000. This is the nil-rate band, the amount you can pass on to anyone without HMRC taking a penny. On top of this, there is the Residence Nil-Rate Band, which is currently £175,000. This is specifically for your main home, provided you leave it to your direct descendants, such as children or grandchildren. When you combine these, a single person can pass on £500,000 tax-free, and a married couple can potentially pass on £1 million. I must provide a necessary legal disclaimer here. These figures reflect the standard thresholds for the 2026 to 27 tax year, but your actual tax-free allowance will depend on the total value of your estate, including savings investments and even high-value personal belongings. The problem arises when your family home, often your most valuable asset, pushes you over these limits. Any value above your combined threshold is taxed at a flat rate of 40%. If your home is worth £700,000 and you're a single parent, HMRC could be looking for an £80,000 payment within 6 months of your passing. This is why the idea of gifting the house early has become so popular. But as we are about to see, doing it incorrectly is worse than doing nothing at all. Section 2. The reservation trap. Gift with reservation. So let us look at the most common mistake parents make. It is what I call the reservation trap, or what HMRC officially labels a gift with reservation of benefit. It usually happens like this. A homeowner decides to sign the deeds of the house over to their children today, believing that if they survive for 7 years, the house will be entirely outside of their estate for tax purposes. However, the parents continue to live in the house exactly as they did before. They don't move out, and they don't pay any rent to their children. In the eyes of HMRC in 2026, this is not a gift. It is a sham. The law states that for a gift to be valid, you must give it away absolutely, and you must not continue to benefit from it. If you stay in that house rent-free, you are reserving a benefit. The devastating consequence is that the 7-year clock never even starts ticking. Even if you live for 20 years after signing the deeds, HMRC will treat the house as if you still owned it on the day you died. Your children will be hit with that 40% tax bill, and because they are now the legal owners, they may not even be able to use your tax-free allowances as effectively as you could have. It is a total administrative and financial disaster. Section 3. The market rent dilemma, the only legal escape. Is there a way to give your house to your children and still live in it? Technically, yes, but it comes with a high monthly cost that many families are not prepared for. To satisfy HMRC, you must pay your children full market rent. This cannot be a token payment of a few £100s. It must be the same amount a stranger would pay to rent your home in the open market. If the going rate for a house like yours is £1,500 a month, you must physically transfer that money to your children every single month. You must also have a formal tenancy agreement in place, and you should ideally pay for your own utility bills and council tax. But here is the secondary sting. Your children must declare that rent as income. They will have to pay income tax on the money you give them, potentially at 20 or 40%, depending on their own earnings. Furthermore, by giving the house away, you could severely complicate your Residence Nil-Rate Band of £175,000, as you no longer technically own the property. At the time of your passing, meaning your executors will have to navigate complex downsizing regulations to reclaim that allowance in your will. You are effectively swapping a future inheritance tax problem for a current income tax problem and risking your tax-free allowances in the process. For most families, this market rent solution is simply not financially viable. Before we move to the hidden legal ways to give away money tax-free, I want to hear from you. Have you ever considered signing your home over to your children, or perhaps you've been advised to do so by a friend? Does the idea of paying rent to your own children feel like a step too far for your household budget? Please share your thoughts in the comments below. Your perspective helps us understand how these rigid HMRC rules are impacting real lives across the country. Section 4. The 7-year clock and taper relief. Now let us assume you do decide to give away a large asset, perhaps a second property or a large sum of cash, and you move out or give up all control. This is known as a potentially exempt transfer, or a PET. This is where the famous 7-year rule truly lives. If you survive for 7 years after the gift, the entire amount is tax-free. If you die within 3 years, the full 40% tax is due. If you die between years 3 and 7, HMRC applies what is called taper relief. However, there is a massive misunderstanding about how this relief works. Many people believe taper relief reduces the value of the gift. It does not. It only reduces the tax rate on the part of the gift that exceeds your £325,000 allowance. If your gift is within your allowance, taper relief provides zero benefit, but it still uses up your allowance, leaving the rest of your estate, like your home, fully exposed to the 40% rate. This is why gifting large sums right before the 7-year mark can often backfire, leaving your family with a much higher tax bill than they anticipated. Section 5. The surplus income loophole, the secret weapon. If the 7-year trap sounds daunting, there is a much safer yet rarely discussed alternative. It is called the normal expenditure out-of-income rule. This is the most powerful tool for pensioners in 2026 to move wealth to the next generation without ever triggering the 7-year clock. Under this rule, you can give away unlimited amounts of money tax-free provided you meet 3 strict criteria. First, the gift must be made as part of a regular pattern of giving, for example, a monthly transfer of £500 to a grandchild's savings account. Second, the money must come from your surplus income, not your capital. This means your pensions and investment dividends must cover your entire standard of living, and the gift is what is left over. Third, you must be able to prove that the gift does not reduce your standard of living. If you document this correctly, HMRC cannot touch that money regardless of when you pass away. It is an immediate exemption. Alongside this, don't forget your smaller annual allowances. You can give away £3,000 per year as a single person, or £6,000 as a couple with no tax implications whatsoever. You can also give £2,500 as a wedding gift to a grandchild. These small regular transfers are far safer than trying to gift a £500,000 house in one go. Section 6. Care costs and deprivation of assets. We must address one final critical warning. Even if you satisfy HMRC's 7-year rule, you may still fall foul of the local council. In 2026, local authorities are under immense pressure to fund social care. If you give your house to your children and then apply for council-funded care 3, 5 or even 10 years later, the council will investigate the transfer. If they believe the primary reason you gave the house away was to avoid paying for care, they can label it deprivation of assets. Unlike HMRC, the council has no 7-year limit. They can look back as far as they like. If they find you guilty of deprivation, they will treat you as if you still own the house. They can refuse to pay for your care, leaving your children in the impossible position of having to sell the house they thought was theirs to pay for your nursing home fees. This is why gifting the house is often the worst possible strategy for long-term security. Section 7. Action Plan. Protecting your legacy. To ensure your family's inheritance remains in their hands and out of the Treasury's reach, here is your 4-step action plan for this month. Step 1. Get a professional valuation. You cannot plan without knowing the size of the problem. Get an up-to-date valuation of your home and all your assets. If you are a couple and your total estate is under £1 million, you may not have an inheritance tax problem at all, and you should stop worrying about gifting the house. Step 2. Maximize your annual exemptions. Stop trying to do everything at once. Start using your £3,000 annual gift allowance now. Ensure these are made via bank transfer with a clear reference like annual IHT gift. HMRC loves a paper trail. Step 3. Document your surplus income. Keep a simple log of your monthly income and expenses. If you are consistently spending less than you receive from your pensions, start a regular standing order to your children. This normal expenditure is your most robust legal shield. Step 4. Consult a regulated professional. Never ever sign a deed of gift based on coffee shop advice. Inheritance tax is a minefield. You must speak to a solicitor or a financial advisor who is regulated by the FCA. They can help you structure your will to use the Residence Nil-Rate Band effectively, which is often a far safer way to protect your home than gifting it. Your home is the foundation of your family's history. Protecting it requires a calm, calculated approach, not a hurried gift that could trigger an investigation. In 2026, the most generous thing you can do for your children is to ensure your financial affairs are so transparent and legal that HMRC hasn't a single leg to stand on. If this investigation has changed how you think about your family home today, please share this video with your children. It is a conversation that every family needs to have before it's too late. Subscribe to the channel and turn on the notification bell to stay ahead of the rules. However, while HMRC is looking at your house, there is another authority that could be quietly monitoring your bank account if you ever need help with care. In my next video, I am investigating the deprivation of assets investigators. I will show you exactly how the local council tracks your spending from years ago, the 3 specific red flags they look for in your bank statements, and the one legal way to spend your money now without losing your right to state-funded care in the future. You won't want to miss that critical report. Thank you for watching, keep your legacy safe, and I will see you in the next financial update.